does get a little confusing, so I'll do my very best to explain it for you guys. Um, yeah, so there's two principles that we kind of need to understand. The first is accrual versus cash-based accounting. So it sounds kind of complicated, but cash-based accounting means your the way you journal is only based on when cash moves, right? You're putting stuff onto your accounts, you're writing stuff down based on when cash moves hands. But that's not always entirely not going to give a good picture because let's say you make like a multi-million-dollar deal, and technically you've already completed the actions for that, or you pay a lot of money for, I don't know, for something that you don't receive yet, you don't use yet. You pay for like an advertisement campaign in the future, right? It'll look really bad for your company because it's like, oh, we just spent millions of dollars, but then you haven't actually recorded anything coming in. That's what like accrual-based accounting is kind of for. And it works under these two principles. It works under the revenue recognition principle and the expense recognition principle. There's a lot of text in the slide, so I'll try to make it easy. Revenue recognition principle is basically the idea that revenue, you'll write that down. You'll write revenue down. If you get revenue, you'll write that down once you have delivered your product. So once I've given you guys or delivered the car that you guys have bought, that is when I say, hey, I've made money, right? It doesn't matter if you guys haven't paid me. I'm gonna write down, hey, I've made like revenue, right? Now for expense, the way it works is once you made efforts to generate revenue. This confuses me a little bit as well, but think of it this way. Once you have used up, you're a bakery, once you use the flour to make the bread, that is when you count the expense, right? Once you, um, once let's say you have a set amount of labor, once you use up labor to build that car, that's when you set that expense, right? Not like let's say if you have like a 3 month period, you won't let's say you paid all your workers beforehand, right? But only when those workers do the work to build the car, do you expense it, right? So you could pay them in advance for 3 months, but only once the first is over, do you say like let's say you pay them $10 every month, right? So you pay them $30 total. The first month will be $10 in expense, second month $10 in expense, and third month $10 in expense. You won't put it all in the first month. A little complicated, um, but that is kind of what this chapter is getting at. Now, there's a lot of text on this slide, so I'll try to keep it short. We do this because sometimes it's easier, right? Because sometimes you have like utility costs for like water or electricity, and it just makes more sense to do it this way. Sometimes it's easier to actually base it on like, when we're actually gaining an asset or losing an asset rather than gaining cash or losing cash. Because, we don't always, sometimes we buy things on credit, we don't instantly pay for them. Um, Also, if you don't do this, like I mentioned before, items may go unrecorded, like the fact that, hey, you just gained like the fact that someone owes you 10 years of living in this building because you paid 10 years of rent, right? That doesn't show up, it kind of looks bad on the accounts. And then the adjusting entries can also, um, make for more accurate financial statements, right? So if you don't do them at the end of the year, you do financial statements, they will be off because sometimes the dates when things happened won't be accurate. You'll see why in a second, which is where we're gonna introduce like these ideas of prepaid and unearned things. So there's four types basically of these adjusting entries, right? We can split them into two categories. We have our wait, let me get my laser pointer out. We have our deferrals. Sounds like a big word, but the only thing you're saying is okay, cash moved first, right? It's always between whether cash is moving first or whether the service is being done first. So if you think here, expenses paid in cash before they're used. This would be if I pay for my insurance. Usually you'll pay for insurance, and then within every time a month goes by, you have kind of used up that service, right? Because you can't use your insurance ahead of time because you're paying to be insured in those months, right? Or Um, let's say you pay rent ahead of time, right? This is also a prepaid expense. You can't use up that renting time, um, even if you pay in advance. And that's kind of what a prepaid expense is. Now, an unearned revenue, as the name kind of implies, you haven't done anything to earn the revenue yet, right? Which means because we know cash moves first and we know it's unearned, we know that you've gotten cash, but you haven't done anything yet, right? So this is if you guys pay me for that car I'm going to deliver to you, but I don't actually provide the car yet, right? Um, this is why, in both cases, either I have paid cash first or I've gotten cash first, right? And then because I'm paying expense or I'm receiving revenue, that's how you kind of distinguish between these two. Hope that makes a little bit of sense. Then the other one, like it says here, is when the service happens first, right? So accrued revenue, basically in this case, we have performed the service, I've delivered the car, but I've not yet gotten the cash, right? But since, if you remember from our concepts earlier, we say that we make revenue whenever we deliver, whenever I provide my service, whenever I perform the service, that's when I say, hey, I've made money, guys, right? And that's why in this say we have gathered up revenue. We have accrued it in this case, right? So the service has been provided, but no cash has been given yet. And then the last one, once again, an expense. Um, this is when we gather up our expenses. So let's say I use up all my flour, I use up the labor, I use I don't know, the coal that I use to fire up the the oven at my bakery, something like that, right? I've used all this up, but I haven't actually paid the person who got me all that yet. So once again, excuse me, the service has been performed in the sense that they have provided me with materials, but I have yet to pay them in cash for it. And that is basically this idea. So here, um, we pay ahead of time for resources, and then we start using them. In this case, we receive money and then later on we deliver, or in this case, we get money before we deliver. And then opposite is with the service first, we provide the service and then get paid later on, and we use the resources and then pay for them later on. That is the idea here. And I think I mentioned it before, but here when I said we'll see it in chapter 3, prepaid insurance. If you look here, wait, this um, would be a prepaid expense because we have paid for our insurance ahead of time and it shows up as an asset, right? Because that's something we can use. Unearned service revenue is if you look here, um, it's from here, right? So we have gotten cash, but we are still liable for those services, right? We still owe those. And if we remember from earlier, liabilities are those things we owe. And since liabilities credit up, it's on the right side here, right? Because it's on the other side of that accounting equation. I hope that makes a little bit of sense. Um, this should add a lot more detail to what this actually means. So basically, starting off with our prepaid expense, if we look here, it's an asset, which is what I said before, right? So because it's an asset and you gain it, it's the debit side. Because it's not obvious here, this is always the debit and this is the credit side. Over here, same thing again, debit, credit, debit. Okay, yeah, there it says it as well. So here, it's just unwritten that those are columns there. So basically, we have our prepaid expense. We have I'll use the example of insurance for this case, right? So we have paid for our insurance. Obviously, double entry. Excuse me, something has to change. In this case, the cash, right? Because we're paying it, and it's worth the amount of cash we're paying for it, and we lose cash. And since cash is an asset, we credit it. Now, once we actually finish with we use up all the insurance, um, at that point, we've used up our asset, right? It used to be an asset to us. Once your insurance runs out, it's not really there anymore, right? So that's when you will credit it and you take it off, and then you can expense it, right? Because now you've made yeah, it sounds a little confusing, but now you've made efforts to generate revenue. Maybe it's a little better to think of advertisement. Insurance can get a little confusing. Or think of rent for a factory, right? When you use up or when you use that factory, you are making an effort to generate revenue. And since our expense, like our principle from earlier says, when we make an effort to generate revenue, that is when we expense things, right? And that is why we have this over here. I hope that makes a little bit of sense, right? And if you remember from earlier, debiting expenses means they go up, right? Just take a quick sip of water. You can also see all of this happening at the bottom here. In case it isn't obvious, we've prepaid for the rent, right? So this is our asset here. And as we're using it up, we take it off, right? Add here, take it off here. Debit the asset, credit the asset, right? Oh, sorry, that's a bit messy. And then since we need to have something on the other side, the thing that we have on the other side for double entry is the rent expense that we start expensing it. Hope that makes a little sense, because now we'll be moving on to the next one. Like I said, anytime if you want me to go back. Sorry, I think I'm gonna, okay, sorry, I'm gonna put on like a tiny bit of background music so that my headphones stop turning off. I apologize. Um, but yeah, so moving on to our unearned revenues. Like I mentioned before, this is when you have yet to perform that service, right? So in this case, you have not done anything to earn it, but the cash has changed hands already. So you see that here. Cash has changed hands, debited, but you owe them. I owe you the car. You guys have paid me. Obviously, you guys should get the car. So to reflect that liability, we credit it over here, right? Once I deliver that car, so once I provide that, I no longer owe you guys, right? But I've also performed the service. And the oh, can you go? Yeah, of course, I can go back in 1 second. Um, I'll just finish this real quick and then I get back to it. But since we have now performed the service, and our revenue recognition principle says when we perform a service, that's when we recognize the revenue. That's why this is when we'll add it to our revenue, right? So I'll say that again real quick. Debit cash. So we gain cash. You guys pay me. This is me, the fact that I owe you guys. I owe you guys a car. Then I provide the car. So now I no longer owe you guys. That's here. And I've delivered the service, so I've made revenue. That's basically what it is. But I can go back real quick. Is there anything specific you had a question about? Or okay, perfect. Thank you. Um, yeah, otherwise if there's no question about unearned revenue, yeah, we can look down here again. Same thing. This is you guys. You guys are paying me for the car. This is me owing you for the car. So, I owe you a car worth $750. Why are the numbers not the same? Um, this is because you mean why like one side is 750 here and the other side is 450? Okay, that's because they use a different example, but I can use their example as well. It's because you guys are paying me for 5 months, let's say like 5 months rent, right? Let's say you give me 5 months rent for 750. That's what it says here. So this is you guys. So I owe you 5 months of rent, and now you use 3 months of it, right? So it says here, provided 3 months. So you use the house for 3 months. So I let you live there for 3 months. So I have used up 3 months that I owe you, but I still owe you 2 months, right? And that is the rest of the money that's missing here, right? So that 300 is what's missing here. That's the last 2 months, and that's why it doesn't add up. So it won't always fully complete. Obviously, in the example I had, I used like a car where, I will give you the entire car, so my entire liability is gone at the same time. That's not always the case. It can be that you use up like only some of that. Like I only make up for like 3 months of what I owe you, which is what happens here. I hope that makes sense. Otherwise, let me know. I can always go back. Um, then yeah, now we're onto our accrued revenues. So like I mentioned before, In this case, our services are happening first, right? So if you guys remember the revenue recognition principle, services, once they happen, that's when we make revenue. So you look here, we're recording our revenue right off the bat. I have given you the car. I see that as making revenue, but you guys owe me now. You guys owe me for that car. So in this case, I get a receivable, right? A receivable as in like I will receive something in the future. It's a bit of a weird word, but it's like, oh, you owe me, right? Then once you know, once you guys pay me for that, I'll get the cash. You guys pay me the cash. That's what's happening here. And then obviously, since you guys don't owe me anymore, I have to take that off my balance sheet. And that's what I'm doing here. I'm crediting the asset, and when you credit an asset, you're removing it, right? Maybe we can look down here. Oh, okay, they actually use my example for once, right? So, car is delivered to the customer, but not yet paid, right? So I've delivered my service, but you guys have not yet paid, so you owe me, which is good for me. That's an asset. And then you guys pay me, bam, 30K. So I gained 30K dollars or 30, yeah, whatever, doesn't currency doesn't matter. And you guys no longer owe me 30,000. So in this case, you can see that unlike earlier, where we had the case where here, let's see, it wasn't completely the same, 450 and 750. In this case, based on what the product is or what the service is, the entire deal was made, right? So once again, this is our accruals, um, while the other ones were our deferrals. And then our last one is the accrued expenses. So in this case, once again, the service moves first. Um, so what happens is we're using up the resources. I think the example they use here is electricity. So we use electricity to run all our machines, right? Which means we're trying to make revenue. And expense recognition principle says when we're trying to make revenue and we use up resources, that's when we expense things, right? But now obviously energy is not free. So now we owe the energy company, and we have a liability we owe them. And that gets credited here. And then once we do actually pay for that, how do we pay for it? We pay in cash. So we lose this cash. But obviously now the energy company's happy, so we're no longer liable for it, right? Same thing happens down here. Expense recognition principle. We've made efforts to generate revenue. We've used the electricity to run our machines, right? So we put the expense there. Um, Payable, we're liable for it. The energy company wants their money, they're going to come for it. They do come for it. We've given them the cash for it now, and we are no longer liable to them, right? So it might be a bit quick, but what you can see here, wait, I'm going to clear this real quick. Erase all ink. What you can see here, electricity expense, this is kind of what gets counteracted by the cash. And then if I go with a different color real quick, maybe orange, this electricity payable liability and electricity payable liability is kind of, those are the ones that are balancing each other out. Because you can see here, this is 300 on the debit side, 300 on the credit side. And then if I go back to red in color, 300 on the debit, 300 on the cash credit. And that's once again how you see how it balances out. I hope that makes sense. Honestly, if there's any of those that don't make sense to you guys, feel free to let me know to go back to them. But the important things to remember for the deferrals, cash moves first. Accruals, service moves first. Revenue, we write that when we perform the service. Expense, we write that when we use resources to make revenue. The last one's usually a bit finicky. It can be hard to apply to all situations, but like the insurance one. But yeah, if you twist your head around it a little bit, then you can usually make it make sense. I hope that's okay for you guys for now, though. Um, and then yeah, based on all of this, obviously our trial balance is going to look. How do we calculate with months? Um, I can give you an example right here. Um, if you think here, wait, let me. Where do I have this? Sorry, guys, I'll be right back. I'm just looking to make sure I grab my calculator when I do the math for you guys. Actually, I could just use their example. I think I'll do that. They have an example here of 750, right? And they have 5 months of rent, right? So if you divide that by 5, right, then you get your 150. And then what you can do is you can basically calculate down the line how much that will run you. Wait, give me 1 second. Um, let's see here. You provided 3 months of the service. So 3 months of the service, multiply, this is like your monthly rent in case that wasn't obvious, right? Your monthly rent times 3, in this case would be equal to 450. And that's basically how you, like the summary. Yeah, of course, I can put I think I also have a notes document that I can shoot in the chat later. So I can see that I remind that. If I forget to do that, make sure to remind me. Oh, I'm asking there something with also with 12 months. You mean an example with 12 months or what do you mean? Was it in the presentation or something? In your tutorials. Um, yeah, that's possible as well. Like really you can always adjust based for how much like you're paying ahead of time. Usually they'll have things like insurance, advertisement, rent. These are usually things that you'll pay ahead of time. So let's say you have I don't know, instead of the 750 for 5, let's say the 750 okay, what's like I'll do 1,200 because that divides nicely by 12. Let's say you have 1,200 in rent, and this is over the whole year. Obviously a fantasy, especially in Maastricht, right? So let's say your rent is 100 per month, right? You can do the same calculations. If let's say you've lived there for 6 months, right? Then you just multiply by 6. That's 600. That would be used up here. If it's 1 month, it would just be 100. If it's 3 months, it would be 300, right? So you can just always adjust based on that, based on what values you're given. It always depends on the case. All right, I hope that makes a little more sense. Um, yeah, there's nothing too crazy going on here. Basically, what we're just saying here is the fact that we're now adjusting all these terms obviously means that our trial balance is going to look a little different, right? And in the accounting process, you will adjust the trial balance, the earlier one you made, based on this. And yeah, that's not going to happen at the end of the year. I think there is a slide where this is explained a little better, so I'll hold off for that because without a visual, it's a bit silly to explain this one. But yeah, moving on.